Hi, Neil Rose here with a quick update. I wanted to flesh out a couple of points that are going to be made in the investment letter going out to you shortly. For months now, I wanted to have an overarching theme about preparing or at least pre-thinking bear market or pre-thinking an environment that isn't so accommodating to investors. It's been a great year. It's been a great many years now in markets, and that alone is reason enough to sort of think a little more defensively, scrutinize investments a bit more, and add in a margin of safety, an extra margin of safety. But there's also reason to look at it that way because what we're seeing in markets, it's been a little troubling in a way. I'll tell you what I'm talking about here. The past year has been a real exclamation point on a multi-year trend, which is equities have been doing really well. The S&P 500, this is as of last week, was up 23% on a trailing year basis. Um, Incidentally, bonds have been negative as interest rates have risen a little bit. So, but stocks have been, I mean, great guns for 10, 11, 12 years now. And yet the averages haven't necessarily been the average company. What do I mean by that? We zoom out. This is 5 years, over 5 years, but you could do it 10 years or maybe even more. But the market has been a story about really two things. One is technology. Technology is the largest sector of the S&P 500. Right now, it's about 28%. And technology, the biggest sector of the market, has been outperforming the market for quite some time. That's number one. Number two is you have a size phenomenon that's been going on, meaning the biggest of the big companies have only gotten bigger and have outperformed. And so, as one talks about the stock market, it means he or she is increasingly talking about fewer and fewer companies to the point where, today, just five companies make about a quarter of the market. Kind of like the 1990s, diversification has not helped in terms of performance vis-a-vis the stock market. Having oversized allocation in one, two, and $3 trillion worth companies has been the place to be. I doubt that'll continue for a lot of reasons, but this is really about what is. What is that the stock market has been a function of size and technology by and large. If we look into these sectors, we see the size effect really playing out. So here's the technology sector on the top. Two names are over 41% of the tech sector, just Apple and Microsoft. The communication sector, which isn't considered tech as a classification, although it is really, but Facebook and Google make up almost 45% of that sector. So the two sectors combined are 37% of the market. Uh, I looked at some numbers. The tech sector plus Facebook, Google, Amazon, and Tesla, you have well over 40% of the stock market in what is just a small handful of names. Nothing lasts forever, of course, and this sort of deterioration of the average stock, and it has been happening. This is the red line here. This is really shows that the momentum of the average Nasdaq stock, and Nasdaq is primarily a tech-driven index, that turned about a year ago. So even though the Nasdaq itself has done well, see that with the white line, the average stock hasn't, to the point where today 4 out of 10 Nasdaq names are down more than 50%. This kind of gap, I can't remember last time I saw something like this. And one of the reasons for this has to be interest rates. As you can see on the left, the interest rates generally bottomed about August 2020, and they've been rising. And one of the things about interest rates are when they're ultra low, people are willing to pay up more for growth. All of a sudden, 50 times earnings or 70 times earnings, one can justify that when your alternative is parking money at the bank earning zero, or lending to institutions for really low rates like below 1%. It gets harder to justify prices like that as interest rates climb. Earlier this year, we saw companies not just at 75 times earnings or 100 times earnings. We saw tech companies with 100 times sales. and some of them are still pretty high. But I wish I knew where interest rates were going. That might be the single determinant in terms of what the markets favor on the equity side. And if interest rates keep rising, it stands to reason that the rotation that we're starting to see might have some legs. And it makes sense. Interest rates are rising. Look at inflation. We finally have inflation again, 7% at last reading. That's the highest number in 40 years. Months ago, I argued that one should anticipate higher inflation, or at least act as if on the investment front, not because I saw higher inflation. I'm not going to forecast inflation. I don't know anybody who does it well, but when interest rates are almost zero bound and the consensus has a story, a narrative about deflation or the impossibility of inflation, then the consensus becomes very fragile to higher rates. And so, as always, you sit there and ask, well, what's the cost of being wrong? And so, but here we have inflation and we have interest rates rising, and it behooves one to invest in a way where one can not be as fragile to interest rates or higher inflation. And you want some things in the portfolio that are beneficiaries of it. Well, how does one hedge against inflation? The best hedge historically has been holding really great companies that grow earnings and dividends at a rate much higher than inflation. They compound. So we can't lose sight. As defensive as we want to be, it doesn't mean you sell out of stocks. We're trying to serve two masters in the sense that we care about losses, but this is still a long-term program. This is a long-term quest that we're all on to grow assets, to preserve and grow purchasing power, to fund retirements, et cetera. And so times like this mean that we should be a little even more scrutinizing of the companies we keep and price and look at quality and really see who's durable and who deserves to grow and what companies don't. But we can't lose sight that having ownership of equities is very important to mitigating risk over time. So over time, especially with interest rates so low, over time, or at least for the medium term, equities will be the biggest driver of returns and even income. But asset allocation is still important. We are looking at ways to, I guess, create more robust portfolio as a whole, deliver more income. We've added commodities as a component, a modest component at that, but our investments in commodities have risen. I have no idea where commodity prices are going, whether it's oil, pork bellies, silver, I don't know. But they do play a role in terms of some of the threats that we see as investors. Inflation's one of them, but commodities, the one thing I know about commodities, they're very cyclical. And so this chart, I think, is probably the most informative thing I can find on commodities in general. And this is 50 years of commodities to equities in terms of leadership. So this is the ratio of the S&P Goldman Sachs Commodity Index. That's the index that a lot of people look at for commodity prices as a whole versus the S&P 500. And what you see in 50 plus years are three tops, big tops, and three big busts. And arguably we're in the third and maybe most severe bust of all. And so as a hedge and a diversifier, I think I'd argue there's probably never been a better time to have a component in commodities in general. And if interest rates go up, which is a threat to some of our valuations in the short term on some companies, I mean, we do have some Microsoft, we do have some companies with 30 times earnings. Good companies, I don't worry about them long term, but in the short term, they could certainly lose value. Higher rates are really good for commodities because cost of capital goes up and the supply gets constrained even more than it already is. So we'll talk about this more in the future. And thanks so much for hanging in there with us. We're living in some interesting times, obviously, and for many reasons, but right now, I'm pretty pleased with the overall diversification and defensiveness of things. I don't think I've ever seen, I've never been this diversified. I mean, when you're holding small companies, big companies, a lot of short-term bonds, a little bit in longer-term bonds, and then with gold, silver, industrial metals, fertilizer, seeds, we've got a lot in the portfolio, and a lot of cash. So we will have a lot more going forward in terms of strategic shifts. But suffice it to say that we are in an increasingly diversified situation. And most importantly, we don't want to be susceptible to any one macro outcome, whether it's inflation, deflation, trade war, taxes, what have you. Uh, we're going to, in the short to medium term, our performance, I think by and large, is going to be a function of quality getting re-rated and diversification becoming more rewarded. And we'll see. But thanks so much. Give me a call if you have any questions.